A 27-year-old entrepreneur earned $10 million faster than most people imagine. His success looked unstoppable, and everyone believed his future was secured. Then, everything vanished in only 48 hours after one mistake. The collapse happened so quickly, nobody could stop the disaster. His fortune disappeared, and his life changed almost overnight completely. Stay and watch until the end, because this lesson could protect you. Before becoming rich, he started inside a tiny apartment alone. He spent years learning business, markets, technology, and customer behavior. Eventually, he launched a startup that solved an important problem. People loved the product and demand increased faster every month. Soon, investors noticed and offered funding to accelerate expansion. That funding transformed a small startup into a growing company. More employees joined, and the company expanded across multiple markets. Revenue increased dramatically, and profits began reaching new records. The media started calling him one of business's brightest stars. At only 27, his net worth exceeded $10 million. His lifestyle improved quickly, and confidence grew alongside his wealth. Unfortunately, confidence slowly transformed into dangerous overconfidence and risk. He began making increasingly larger bets with his growing fortune. Several advisors warned him, but success made him ignore caution. Then he discovered an opportunity promising extraordinary returns very quickly. Everyone around him seemed convinced the investment could not fail. He committed an enormous percentage of his wealth into it. What happened next would erase years of success almost instantly. For several weeks, the investment performed exactly as everyone expected. His account balance increased dramatically, and confidence reached dangerous levels. Friends praised his brilliance and reinforced his belief in success. He started teaching others how easy wealth creation seemed. Even market headlines appeared to support his growing confidence. Unfortunately, risk management slowly disappeared from his decision-making process. Diversification seemed unnecessary because everything appeared to be working. His entire financial future became dependent on one opportunity. Experts continued warning him, but he believed they were wrong. Recent profits convinced him that caution only limited potential success. He increased his position size again despite growing exposure risks. Then the first warning signal appeared without attracting attention. One morning, prices dipped slightly and investors stayed calm. He viewed the decline as another opportunity to buy more. Soon, unexpected news created uncertainty across the broader market. Market volatility increased, and investor confidence began weakening rapidly. For the first time, he started feeling slightly uncomfortable. Small losses are manageable, but concentration risk magnifies every mistake. The decline accelerated, and losses became impossible to ignore. Thousands disappeared from his account within only a few hours. Fear spread quickly as more investors rushed toward the exits. What seemed temporary suddenly felt much more serious and dangerous. Every notification brought worse news than the previous alert. The next 24 hours would determine his entire financial future. The following morning brought even larger losses than anyone expected. Millions in market value disappeared before lunchtime even arrived. He contacted advisors searching desperately for reassurance and guidance. Their message was simple. The situation was becoming extremely dangerous. For the first time, panic began replacing confidence and optimism. The concentrated investment structure started collapsing under increasing pressure. More investors sold their positions, creating additional downward momentum. Every decision felt risky, and every minute brought uncertainty. A major news announcement intensified fears throughout the entire market. Prices dropped sharply again, shocking even experienced market participants. His remaining fortune was shrinking faster than he imagined possible. This is why preserving wealth matters more than chasing returns. That night, sleep became impossible as losses continued growing. He checked prices constantly, hoping for signs of recovery. Instead of recovering, the numbers continued moving in one direction. Every update confirmed that the situation was worsening rapidly. Emotions dominated decisions as fear replaced rational market behavior. He faced the hardest question: sell now or hold longer? Successful investing requires strategy precisely when emotions become strongest. Unfortunately, hesitation can become extremely expensive during market crises. The market downturn was transforming into a full-scale collapse. Millions had already vanished, and the worst was approaching. Confidence was gone, replaced by fear, regret, and uncertainty. Within the next hours, everything he built would be tested. But the market decline was not the entire story behind disaster. A deeper problem was hiding beneath the visible market chaos. The investment relied heavily on borrowed money called leverage. Leverage increases profits during gains, but multiplies losses during declines. Previous success convinced him that leverage was helping rather than hurting. Many investors underestimate leverage because risks remain invisible during booms. Then a margin call warning appeared on his account. A margin call demands additional funds when losses become excessive. Unfortunately, most of his available cash was already invested. His financial flexibility disappeared exactly when he needed it most. Liquidity problems often destroy investors before markets can recover. He now faced a deadline with very limited options remaining. He started selling assets to meet urgent financial requirements. Selling pressure pushed prices lower and increased overall losses. One problem created another, forming a dangerous financial chain reaction. This feedback loop traps investors inside accelerating downward spirals. He searched for emergency solutions, but opportunities were disappearing. Lenders became cautious because market conditions were deteriorating rapidly. His portfolio crossed a level that triggered automatic liquidations. The system started selling assets regardless of his preferences. Losses accelerated dramatically as forced sales hit unfavorable prices. Years of effort seemed to be disappearing before his eyes. The real mistake was excessive leverage combined with concentration risk. The second half of the 48-hour collapse was about to begin. The next few hours became the most expensive of his life. Millions disappeared faster than he had earned them originally. Every available option now involved accepting painful financial damage. Time became his enemy as deadlines approached relentlessly. To understand this collapse, we must understand leverage more clearly. Leverage allows investors to control larger positions using borrowed money. Profits grow faster with leverage, but losses grow faster too. Higher rewards often come attached to dramatically higher risks. When markets reverse, leverage can quickly become devastating. Successful investors focus on survival before maximizing potential returns. He now realized those earlier warnings contained valuable wisdom. Diversification exists specifically to reduce catastrophic financial outcomes. Spreading risk prevents one mistake from destroying everything you own. Concentration creates wealth quickly, but also destroys wealth quickly. Meanwhile, his account continued deteriorating beyond recovery levels. The liquidation process accelerated because prices kept falling lower. Each forced sale triggered additional pressure across connected positions. This chain reaction explains many famous market collapses throughout history. The pattern repeats whenever greed and leverage combine excessively. He finally understood that success had blinded his judgment. Confidence is useful until it prevents honest risk assessment. Protecting capital should always come before pursuing extraordinary gains. By now, only a fraction of his fortune remained. The final stage would reveal the true cost of one decision. At this point, Most of his fortune had already disappeared. He began analyzing every decision that led to disaster. The collapse was not one mistake, but several combined errors. 4 factors caused the downfall: leverage, concentration, emotion, and overconfidence. Success made him focus on rewards instead of risks. When rewards dominate thinking, risk management often disappears completely. Professional investors rarely place everything into a single opportunity. They spread capital across different assets to reduce uncertainty. Diversification may limit gains, but it protects long-term survival. The first rule of wealth building is preserving capital. Most successful investors prioritize avoiding catastrophic losses above everything. They build safety systems before taking meaningful financial risks. Maintaining cash reserves provides flexibility during unexpected market turmoil. Cash creates options when others are forced into bad decisions. Unfortunately, he invested nearly everything and kept little protection. Another major mistake was allowing emotions to guide actions. Fear and greed often create the worst investment decisions. Professionals rely on systems rather than temporary emotional reactions. His actions eventually drifted far away from his original plan. Strong risk controls can prevent small mistakes from becoming disasters. Think of risk management as guardrails protecting financial journeys. The collapse delivered lessons worth far more than money. Now came the final chapter of the 48-hour collapse. The outcome was unavoidable, but the lessons would last forever. After 48 brutal hours, the final liquidation process arrived. The remaining positions were sold automatically at unfavorable prices. Years of gains vanished in less than 2 days. The screen stopped moving, but the emotional impact remained. From $10 million, only a small percentage remained. This was not bad luck alone. It was preventable. Looking back, warning signs had appeared long before collapse. The problem was not seeing them, but ignoring them. The biggest risk was never the market itself. The greatest danger came from overconfidence and poor discipline. Luxury, status, and confidence disappeared alongside the money. Assets were sold, expenses reduced, and priorities changed dramatically. Yet, something important remained after the financial destruction. Experience survived, even though most of the money did not. He began rebuilding using wisdom earned through painful mistakes. This time, risk management became the foundation of every decision. Future investments focused on sustainability rather than quick riches. The lesson extends far beyond one entrepreneur's experience. Anyone can make this mistake when success creates false certainty. Many financial disasters begin with confidence, not fear. Making money matters, but protecting wealth matters even more. His fortune disappeared, but his understanding became much stronger. And that understanding would shape every future financial decision. The collapse was devastating, but the story was not over. Before you leave, remember the most important lesson from this story. Rule 1. Protect your capital before chasing bigger returns. Diversification seems boring, but it protects long-term wealth. Always keep reserves available for unexpected opportunities and emergencies. Discipline beats greed when building sustainable financial success. Successful investors follow plans instead of emotional reactions. Now tell me, what was the biggest mistake in this story? Share your answer in the comments and explain your reasoning. Do you think you would have acted differently in his position? If you learned something valuable today, please like this video. Subscribe now so you never miss future finance stories and lessons. It is not too late to build wealth wisely. See you in the next video.